Actually a very important protection. So if your fund manager says, we want to cash out, we're just in it for the quick cash on the hotel, you do have that option to get into another fund and then apparently tack your 10-year period, and you're actually not harmed that much if you can find another investment. So then Google twice. Here's the hard way. The hard way is what I'm doing more of now, which is people who want to open that box and say, I want to create my own building on a variety of ways. Maybe it's a mom and pop and they're just like, we like to build buildings. Let's build our own buildings. Maybe it's someone who says, I want to bring my friends in. I want to syndicate this to a couple people. So that's something you may have clients who are also interested in that. So the two factors I want to keep in mind is you now have the business risk, not just the investment risk, but you have the business risk. You're managing this enterprise. It has to be a success. So that should always be the first thought you have when you're thinking about, I'm going to start a fund, I'm going to invest in something, is, do I know what I'm doing? Is this going to make money? Because in 10 years, you want to sell that at a profit. Don't get all wrapped up in the fact that you can defer the gain from your IBM stock and your Mona Lisa painting. That's nice, but the real reason you're doing this is so that at the 10th year, you can sell an appreciated asset for a gain. So you have to know how to appreciate your asset. And the other reason to make this hard is lawyers. You have to pay transaction costs. So hard and easy way. I'm now going to go into some more detailed dynamics on the easy way. Step one, as I said, you sell your capital asset. It's got to be a capital gain asset. So that's why I wrote, are you eligible for these tax benefits? Sometimes, you sell a partnership interest and you have hot assets, you're familiar with this, that you'll have ordinary income. So sometimes you think you're going to get a capital gain and you don't. You've got to be very careful. This only applies to capital gains. There is indication that it will apply to dividend income actually, because that can be treated as capital gain. So just make sure you got a capital gain that you're going to defer. And also ask if you're eligible, but also ask if you're interested in these tax benefits. Because remember, the premise I've just given you, here's what you're getting out of this. You're getting tax deferral and you're getting a basis step up. Not everyone cares about that. Who wouldn't care about that? I think, and I've talked to Peter about this, and maybe I'm overstating my concern here, but certainly if you have someone who is an older person, who's invested in real estate, who's planning on giving all their assets on to their next of kin, then they can already get a basis. Every one of us has a God-given ability to step up the basis in our assets once by dying. That's Revenue Code 1014. And everyone can defer gain by not selling. So I don't want to pressure every particular individual to sell their assets and get into a qualified opportunity zone just because it's here. It's not right for everyone. But as Peter responded to my comment in that conversation, cash is king, and a lot of people do want to get out of investments at various stages in their lives. So having this ability to get a step up, for other people, you're 30, you're 40, 50, 60 years old, is appealing. So not to overstate my own point. So if you have this, then the second step, after you sell your asset, is to write a check to a qualified opportunity fund investment. So the two things to think about are timing and the amount of gain to deferral. Timing is that you have 180 days. This happens to be a number you may be familiar with. It's the same number out of 1031s. In a 1031, you have 45 days to identify your asset, 180 days to actually fund the next asset. But this has a couple variations. First of all, unlike with the 1031, you're allowed to touch the asset. You're allowed to have the cash yourself. You don't need to have an intermediary. You don't have to have a chain of custody that you're investing that cash. You can liquidate your painting, get the cash, spend it, regret your decision, liquidate something else, or borrow from a bank and get new cash. And as long as you put that new cash in within 180 days, you've met your obligations.
And it's like also too, it's also unlike 1031, it's only the gain that has to get rolled over. Where say you had $1 million of basis and you had $2 million gain, you only have to roll in the $2 million. The $1 million you can take and keep. So it's only the gain portion that has to get rolled over. Unlike a 1031 where you got to put it all in.
Yeah, that's another great. They're more generous in how you can do the QOZs. I'm thinking maybe they learned lessons from they had all these constraints with 1031s that they realized they didn't need to keep. And a third And my favorite of the liberalizations of this rule is for pass-throughs. If you get your gain on a K1, it's no longer a 180-day rule timed from the date you sold your asset. Instead, it's 180 days from the last day of the tax year of the pass-through which sold the asset. And the logic of this is, you're a member of a partnership, you don't talk to the GP, you don't know what they're doing, and at any time in that year they sell an asset, they never tell you. And of course the partnership could choose to do a QOZ, that's their business, but maybe they won't. And at the end of the year, you, for the very first time, you all get together and say, so let's talk about the partnership. Oh, we sold this asset on January 2nd of the year, 364 days ago. Well, Treasury realizes that kind of puts you, the K1 recipient, in a bind. And so they allow you to start your 180 days from that day, the last day of the partnership tax year. In the most extreme cases, if the partnership sells an asset on January 2nd of 2019, then you will have till June 29th of the following year, which is 580 something days. Very generous, and it means that you may have clients who sold assets last year in January, and they thought, oh, 180-day rule. I'm way out of that. It's too late for me to do a zone. But in fact, they still have 5 more months to take advantage of deferring those gains. That's why it's my favorite rule. Then steps 3 and 4 are do nothing and do nothing. The first do nothing is that you do nothing until April 15th of 2027. And on that date, you go back to that date where you think, oh, I sold this painting back all these years ago and I deferred all this gain. Then you write the check to the government for that. But if you did what I told you to do and held for 5 years and 7 years, then you don't have to write the full check for all the gain from the painting. You get that basis boost of 15%, and you only write a check for 85% of the gain from the painting. So good for you for doing it right. And then you keep doing nothing until as long as you can. If you wait 10 years, then that's when you're eligible to sell for a stepped up basis. But why sell? Why not wait 15, 20, 25, 30 years? You'll get that benefit whenever you sell. So do nothing until as long as you can, until 2048, when you just can't hold on to it anymore, and then sell it tax-free. And you now are an expert on this way of investing in a fund. Now, there are advantages to buying now. There's a strong incentive to, in fact, buy in 2019. They bake this into the rules. So if it's December of 2019 and you're thinking, should I invest in a fund now or should I wait a month? You should invest in December of 2019.